Listen, it's the afternoon of January 12th, 2026, and while everyone else is scrolling through political drama on their feeds, the most important asset in the world just broke a 50-year equilibrium. And the mainstream financial networks? Crickets. Complete silence. They're calling this a speculative retail mania, or maybe a temporary supply chain hiccup if they're feeling generous. But I've been staring at my Bloomberg terminal for the last 3 hours, and I can tell you exactly what this is. This is a structural collapse of trust. I'm a private commodities analyst. I've been stacking physical silver for 12 years, and I built this channel because I got tired of waiting half a day for CNBC to report what I was seeing happen in real time. I use this AI avatar for one reason: speed. While everyone else is editing footage and waiting for approval, I can get this information to you now, because that's what matters in markets like this. So here's the situation. Right now, the digital ticker says spot silver is trading at $85.55 per ounce. But if you actually try to buy a physical American Silver Eagle, you're paying $100. And that's if you can even find one. Walk into your local coin shop and you'll see empty display cases. Check the major online dealers and you'll see out of stock or call for pricing plastered across half their inventory. But that isn't even the scariest part of this afternoon's data. Because while you were distracted by headlines, the Department of Justice moved against the Federal Reserve. Not a warning, not a hearing. A criminal investigation into Fed Chair Jerome Powell tied to a $2.5 billion renovation scandal. And when the people in charge of the money start investigating each other, the smart money stops looking at the dollar and starts looking for the vault keys. So let me be crystal clear about what we're dealing with here. This is a perfect storm, not the kind of phrase people throw around lightly. I mean a genuine convergence of catastrophic events. You have a criminal investigation into the Federal Reserve Chairman. You have a complete production halt at the United States Mint. And you have a physical silver market where the actual metal has completely decoupled from the paper price. This isn't about stacking for a rainy day anymore. This is an institutional run on the vaults. In this video, I'm going to break down 3 things for you. First, the backwardation trap that has institutional shorts absolutely panicking right now. Second, I'm going to run the math on why a $100 Silver Eagle is actually a fair price in a broken system. And third, I'm going to share my personal battle plan for how I'm handling my physical holdings as we cross this $100 threshold. Because I've been through volatility before, but I've never seen anything quite like this. Before we dive into the charts and the technical analysis, you need to understand what just landed on Jerome Powell's desk. Because this isn't background noise, this is the catalyst that broke the dam. Let me give you the market snapshot from this afternoon. 2 p.m. Eastern. Spot silver, $85.55 per ounce. That's up 7.09% today alone. Spot gold is sitting at $4,610. But here's where it gets interesting. Physical American Silver Eagles? I was checking prices across the major dealers about an hour ago. JM Bullion has sold out 90% of their junk silver inventory. APMEX and SD Bullion are showing $100 plus pricing tiers for Silver Eagles if you're paying by credit card. Some dealers aren't even listing prices anymore. They're telling customers to call. And then there's the United States Mint. The official statement came out 3 weeks ago. They're delaying the 2026 coin release by 1 full month. The world is waiting for February 26th, but the market is starving right now. Today, this afternoon, there's no inventory to meet the demand that's pouring in. Stop for a second. Look at what just happened on the chart. I'm looking at a vertical breakout candle that cleared the $83.60 resistance we tested back in late 2025. This isn't a slow grind higher. This is a God candle. The kind of price action that happens when something fundamental breaks in the supply chain. Now let's talk about the Department of Justice, the $2.5 billion Federal Reserve renovation project. The subpoenas that just went out. I'm not going to speculate on guilt or innocence. That's not my job. But here's what I know as someone who watches institutional behavior for a living. When the people in charge start investigating each other, trust evaporates. And when trust evaporates in a fiat currency system, people look for hard assets. They look for things they can hold, things that don't depend on someone else's promise. The smart money isn't waiting to see how this plays out. They're moving now. So let me teach you something that's going to make the rest of this video make a lot more sense. It's called backwardation. And if you understand this concept, you'll understand why the banks are absolutely terrified right now. Backwardation is a market state where the right now price is significantly higher than the later price. Let me give you an analogy that'll make this click. Imagine you're at a crowded restaurant. It's packed. You're starving. The waiter comes over and gives you 2 options. You can pay $100 to eat a steak right now, or you can pay $80 for a voucher to eat the same steak in a month. Which one do you choose? If everyone in the restaurant is paying the $100, you know the kitchen is running out of food. That's backwardation. It's an emergency delivery signal. It means the market is so desperate for physical metal right now that they're willing to pay a premium over the future price. Now here's where it gets institutional. I've been watching the CME data, the commodities exchange. 3,000 contracts just rolled backward from March delivery to January and February delivery. Think about what that means. These are big players, banks, industrial users, solar panel manufacturers. They're paying extra to get their metal now instead of waiting. They're not doing that because they're speculating. They're doing that because they're terrified they won't get their metal if they wait. This proves the shortage isn't just retail stackers like us buying silver eagles from our local coin shop. This is Tesla. This is First Solar. This is JP Morgan's vault operations. They're all scrambling for physical delivery. And when you see backwardation this extreme, it tells you one thing with absolute certainty. The system is running out of physical metal. The banks are paying a premium to get out of the way of the train. But can the train actually be stopped? Let's look at the math. I want to run two scenarios for you. One conservative, one stress test, because you need to understand both to make informed decisions. Conservative scenario. Right now, we're looking at a 17% physical premium over spot. Spot is 85.55. Physical American silver eagles are selling for $100 or more. That's a 17% gap. Now, let's say spot silver crashes back down to $75. What happens to physical? Does it crash to 75? No, because the supply vacuum doesn't disappear just because paper contracts sold off. The physical reality might only drop to $90. You'd still have a 20% premium because there's still no metal on the shelves. That's the conservative case. The premium compresses slightly, but the physical price stays elevated because it's the underlying shortage hasn't been resolved. Now the stress test scenario. What happens if the $100 psychological barrier triggers a force majeure in London or New York? Force majeure means extraordinary event. It's the clause that lets an exchange say, we can't deliver the metal, so we're settling in cash instead. If that happens, if the COMEX or the LBMA defaults on physical delivery, you're looking at a complete decoupling. Spot price becomes irrelevant. Physical price is whatever the last guy who actually has metal decides to charge. I've seen estimates that range from $150 to $200 per ounce in a true default scenario. I'm not saying that's guaranteed. I'm saying it's possible. And the probability is higher today than it was yesterday. Let's do the gap analysis on production. The United States Mint can produce about 3 million silver eagles per month when they are running at full capacity. Right now, they're delayed by a month. So we're looking at zero new supply until late February. But demand? I've been tracking the dealer sales data. We're seeing spikes of 4 to 5 million ounces in single-day demand across all the major platforms combined. The numbers physically do not match. You cannot meet 5 million ounces of demand with zero supply. Basic math. So here's what we know so far. Spot is 85. Physical is 100. The Fed is under criminal investigation. The Mint is delayed. And the COMEX is in extreme backwardation. That's the bull case. But there's a massive argument against everything I just said. And you need to hear it before you make a move. The skeptics have a legitimate point. Let me steelman their argument because I'm not here to sell you hopium. I'm here to give you the full picture. Skeptic argument number one, the scrap flood. At $85 per ounce, people are going to start raiding their grandma's silverware drawer. They're going to sell their old jewelry, their coin collections. All that scrap silver is going to flood the market and crash the price back down to reality. Supply and demand. Economics 101. Here's why that's wrong, or at least why it's incomplete. Yes, scrap sales will increase. They always do when prices spike. But here's the problem. Refinery bottleneck. Even if 10,000 people walk into pawn shops tomorrow and sell their sterling silver forks, that metal has to be refined into 0.999 bullion before it can meet industrial demand or investment demand. Refineries are already running at capacity. The backlog is weeks to months. The squeeze is happening in days to weeks. The timeline doesn't line up. By the time that scrap silver gets refined and hits the market, the squeeze will have already played out. Either the price will have gone parabolic and settled at a new equilibrium, or the system will have found a way to suppress it through margin hikes and cash settlements. But the scrap flood isn't going to save the shorts in the next 2 weeks. Skeptic argument number two, industrial substitution. They say that if silver gets too expensive, companies like Tesla and First Solar will just switch to copper or aluminum or some other conductor. Problem solved. Demand drops, price drops. Let me destroy this myth right now. You cannot re-engineer a solar panel in an afternoon. These companies have supply chains that are locked in for quarters or years. They have contracts. They have production lines that are calibrated for specific materials. Switching from silver to copper in a photovoltaic cell isn't like swapping out a light bulb. It requires research, testing, regulatory approval, retooling entire factories. That process takes years, not weeks. So yes, if silver stays at $100 for 5 years, you'll see substitution. But in the short term, In the next 3 to 6 months, they're stuck. They have to pay whatever the market demands. And that's what's driving the backwardation. They know they can't wait. They know they can't substitute. So they're paying the premium to lock in their supply now. Stop. Look at this chart. I want you to see something. Open interest is falling, while January delivery demand is rising. That's the short squeeze signature. It means traders who were betting on lower prices are closing their positions. They're buying back their shorts. And the people who are taking delivery are refusing to sell. That's how you get vertical price action. The skeptics are counting on a supply of silver that is currently sitting in junk drawers and jewelry boxes. The market needs it in a vault. Refined. Certified. Deliverable. And that gap is what's driving this entire move. So what happens next? Let me give you my read on how the institutions are going to react. First, expect margin hikes from the CME. They'll frame it as cooling an overheated market, but what it really does is protect the shorts. If you're a speculator holding silver futures on leverage, a margin hike forces you to either post more cash or close your position. That creates selling pressure. It's a pressure release valve for the exchange. I'd say there's a 70% chance we see a margin hike within the next week if spot stays above 85. Second, watch the dashboard. I'm tracking 2 specific indicators every single day. CME delivery volume. Are they settling in cash or metal? If you start seeing a surge in cash settlements instead of physical delivery, that's a red flag. It means the vaults are empty and they're paying people off instead of delivering the actual silver. Second indicator, the physical premium spread. Is it widening or narrowing? If it keeps widening, the squeeze is intensifying. If it narrows, the system found a way to release pressure. Third, the media blackout is going to shift. Right now, they're ignoring this. But as prices go higher, they're going to flip the narrative. They'll start running stories about how silver is a scam, how it's a bubble, how retail investors are going to lose everything. They did the same thing with GameStop, the same thing with Bitcoin when it first ran. It's a psychological operation to discourage new buyers and shake out weak hands. I'm telling you this so you're prepared. When you start seeing CNBC run segments titled "The Silver Bubble is About to Pop," that's not analysis. That's narrative control. So the system is shaking, the metal is gone. Now let me tell you exactly how I'm playing this. This is not financial advice. I'm not a registered advisor. This is my personal strategy based on 12 years of experience in this market. Trigger 1. If spot silver crosses $90, I'm personally pausing all physical purchases. I refuse to chase the vertical line. I've seen too many people buy the top of a parabolic move and then watch it retrace 30% in a week. My stack is already built. I've been accumulating for over a decade. I'm not going to blow up my position with FOMO buys at 90 or 100 or 120. If I miss the run, I miss the run. I'm okay with that. Trigger 2. If Jerome Powell is fired or resigns, I'm looking to move capital into silver mining equities. Not physical, equities. Because if the Fed chair gets removed in the middle of a monetary crisis, you're going to see high beta volatility in the mining sector. Companies like First Majestic, Pan American Silver, Wheaton Precious Metals, they'll move 3 to 5 times harder than the metal itself. That's where I'll look to capture the momentum trade. Trigger 3. If I see premiums on 100-ounce bars drop below 5%, I will consider rotating some of my junk silver into larger bars. Why? Because junk silver trades at a higher premium due to smaller size and collectability. If I can lock in those gains and consolidate into lower premium larger bars, I'm effectively getting more ounces for the same dollar value. That's a strategic rotation, not a panic move. And here's the most important rule. If silver stays in this $85 battle zone for the next few weeks, I'm doing absolutely nothing. My stack is my insurance, and I don't sell insurance during the storm. I don't care if my neighbor is panic selling his Eagles at a 10% loss because he thinks it's going to crash. I do not care if some YouTuber with 10,000 subscribers is telling everyone to sell and buy Bitcoin instead. My conviction is based on fundamentals. Supply, demand, monetary instability. Those fundamentals haven't changed, so neither has my plan. The goal isn't to be the richest person in the room. It's to be the one with the most options when the doors lock. Let me bring this all together. We are in a confirmed physical squeeze driven by a Federal Reserve in crisis and a broken supply chain. Spot is a lie. Physical is the truth. The spread between the two is 17% and widening. The banks are in backwardation. The mint is delayed. The DOJ is investigating the Fed chair. And retail investors like us are sitting on metal that is becoming increasingly difficult to acquire at any price. This is the moment we've been talking about for years, the moment when the paper price diverges from the physical reality, when the system's vulnerabilities get exposed in real time, when the people who own the actual metal have the leverage. But I need to say this clearly. Don't let the volatility shake your conviction. And don't let the FOMO break your bank. This is a marathon, not a sprint. If you've been stacking for years, you're already in position. If you're just starting, don't chase the $100 eagles. Wait for a pullback. Wait for premiums to compress. Build your position intelligently over time. Things are moving fast, faster than I've seen in my 12 years watching this market. If you want to understand why the DOJ moved now, go watch my previous deep dive on the Fed renovation scandal. I break down the timeline, the subpoenas, the $2.5 billion in questionable contracts. It's all connected. I'll see you in the next update as the $100 level breaks, or holds, or collapses. Whatever happens, we'll go through it together with real data, real analysis, and zero hype. Stay sharp out there.